Hello everybody, welcome back. My name is JoJo if you are new stopping by here. On this channel, I share with you our family's journey to financial freedom. For us, that includes paying off debt, saving, and investing. If that's something you'd be interested in following along with, then please consider subscribing. Today's video is one of the more unconventional ones on my channel because if we use a velocity banking strategy, that is essentially where you use two-way simple interest lines of credit, such as a home equity line of credit, a personal line of credit, and credit cards to pay down large chunks of principal on one-way amortized interest loans, such as consolidation loans, car loans, mortgages, all of those sort of things where they have a set term, a set minimum monthly payment that will give you an amortization schedule. Interest is front-loaded on those types of loans. So this strategy saves money on interest and allows the payments that you make to apply more towards principal instead of interest, thereby allowing you to save money and pay down the loan or debt faster. This is my Velocity Accounts tracker, and I do this tracker every month because, as I mentioned, the Velocity Banking strategy uses lines of credit to pay down amortized interest loans. The line of credit that we are using is our home equity line of credit. And the debt that I am using it on is our student loan. It was a refinance. It was about $68,000 that I refinanced back in 2016. It was a 15-year term loan. It had about a $540 monthly payment, and I was going to end up paying about $30,000 of interest if I had fulfilled that loan, which it would have cost me almost $100,000 to borrow $68,000. And so what I ended up doing was paying off that amortized loan through that lender and housing that debt within our home equity line of credit. And the home equity line of credit that we have calculates interest based on an average daily balance. What that means, there's the 30-month period that they calculate interest off of, and I can, if I try to hold that balance down, that principal balance down as low as possible for as many days of that billing cycle as possible, that will lower the amount of interest that the bank can charge me. So what I do is I house our checking account money, my sinking funds, our savings, and all within our home equity line of credit. But I still want to use those accounts for their intended purposes. So I need to keep track of how much is actually in each of those accounts. So if I wanted to completely pull them out or to know how much I have access to, is I keep track of it on this sheet right here. On the back side is where I have my transaction log. I was making some notes over here. There have been a lot of transfers going on, but this is kind of how I keep track of money flowing in and out of our home equity line of credit. And then I pull from these numbers to update this table, and that's what we're going to be doing today. So first, starting with checking, the total amount of money that had flowed into our checking account, and meaning was transferred into the home equity line of credit, was $5,769.94. The total amount of money contributed to our sinking funds was $2,030.38. We deposited $50 into savings 2, into savings 1, nothing into savings 2, and the amount of principal payment, this was the actual amount of our debt. It was $42,000 that I had used from the HELOC to pay off my student loan. So far, I've paid off $18,862.51 of that $42,000. In the month of February, I was able to put an additional $2,306.15 towards that debt. So all of the money flowing in was $10,156.47. Now we need to look at the money that was flowing out. For checking, I had withdrawn a total of $12,786.53. And again, these aren't physical transfers. It's kind of a more abstract view of your money and how it's flowing and transferring within these accounts. So if you were physically moving the money, what would that transfer look like if there was a separate account for sinking funds, a separate account for checking? How would those transfers look? These aren't physical transfers I'm making. It's just more of a tracking of that transfer. I hope that makes sense. Again, this is just a very unconventional budgeting system that we use, but it has been so successful for us. We actually, if you watch my February budget closeout, we are now using this to pay down our mortgage, and I cannot wait to see the success with that. So the total amount, that was it. We didn't make any other transfers out of these accounts, was $14,248.07. Now we're going to look at our ending balances. And I'm not going to start tracking our mortgage principal until I get this paid off, because that's going to have a different total amount. So next, for checking, that left us with $882.78 in checking, and I do have an actual checking account as well, and that I usually leave about $500. So if I have the $500 for my actual checking account, total in checking is the $500 plus this $882.78. And then sinking funds, and this should look, sinking funds, that should look very familiar to my sinking fund closeout from February, because these are the exact same numbers. But I have $7,213.91 left in sinking funds. Savings one is up to $1,113.12. And savings two is at $4,621.53. Principal paid is now at $21,168.66. So as soon as this totals $42,000, that student loan will have been paid off, because that's how much I pulled to pay off that student loan. And all of this adds up to $35,000. So the starting balance on our home equity line of credit when we started February was $2,908.40. That's what the bank saw to charge me interest on. That is obviously a lot lower number than the $20-something thousand that I borrowed to pay off my student loan. And again, that is the whole purpose of using this strategy. You lower the principal balance that the lender can see to charge you interest on. And since this is a simple interest line of credit, I can transfer money back and forth as much as I want to, and I have access to this line of credit for another 6 years. So right now, the total amount that this adds up to is $35,000, and the total amount of interest that the bank charged me was $10.04. You're gonna see this go up next month because I did pull out $20,000 from our home equity line of credit to go towards our mortgage. It's still going to be a lot lower interest than the bank was charging me on my mortgage. Again, I'm not including that over here yet. The student loan is essentially going to kind of absorb that interest as being tracked towards its payment, which I'm still okay with, because this is going to, in the long term, shorten the amount of time it takes us to pay off our mortgage. And by that time, the student loan is going to be long gone. So the interest overall is $405.01 since I started this strategy. It's been a little over a year since I started this. I think it was in November or December of 2020, I believe. But again, that amount compared to the $30,000 that I was going to pay total had I just stuck with the amortized interest loan is way better, so I'll take it. I borrowed this money. You borrow money from people, you have to pay extra back. That's just kind of how that works for the most part. So I borrowed this money. I need to now pay the piper, right? So now my HELOC ending balance, since I have a total of $35,000, it's $42,000 total. So $42,000 minus the $35,000 is $7,000, and that is exactly what my statement had said, was $7,000. That was the principal amount that the bank had seen and thought that I was borrowing from them at the time. So that is it, you guys. That is where our accounts are ending for the month of February. Now we'll start the month of March, and I hope you guys enjoyed this video. If you have any questions, please leave them down below. If you want to learn more about the velocity banking strategy, check out my playlist. I'll leave that linked in the description box below, and I will see you guys next video. Bye, everyone.